On Friday, the latest job report came out from both Canada and the United States, and we should not ignore what these reports are telling us. I am just going to say that it has been a very, very rough summer for the North American labor market. Canada lost jobs in August. Unemployment pushed up to its highest level since 2016, if we set aside those pandemic years. In the US, job growth nearly stalled. Unemployment ticked up as well. So I want to look here at what these numbers are telling us. They're basically bad for everyone, for workers, for businesses, and for the central banks on both sides of the border. I'm going to break this down in this complete North American jobs picture. I want to start right here at home. Canada lost 66,000 jobs in August. Lost 66,000 jobs. And that follows a decline of 41,000 in July. So that makes 2 months in a row now of job losses. The unemployment rate rose to 7.1%, up from 6.9% in both June and July. And what makes this most particularly significant here is that economists had actually expected a modest growth of 10,000 jobs in August, but instead the economy actually swung in the other direction, and it swung pretty hard. The labor force itself actually shrank by about 31,000 people. So this means that fewer Canadians were actively looking for work. If we take that decline out, the unemployment rate would have climbed even higher. Now, when we zoom into certain industries, the pain was pretty much spread around. We had professional, scientific, and technical services losing 26,000 jobs, transportation and warehousing down by 23,000, manufacturing fell by 19,000 jobs. A bright spot, construction added 17,000 jobs. And when we look at the types of jobs, most of these declines came from part-time work, a loss of 60,000 positions. Full-time slipped by 6,000. Interestingly here, even with this weak hiring picture, wages in Canada are still climbing. The average hourly pay was up 3.2% year over year in August. That also matches July's 3.3% growth. Now let's shift down to south of the border. In the US, job creation in August was expected to come in around 75,000 new positions. You can see that on the chart here. Instead, the Bureau of Labor Statistics reported just 22,000 new jobs. And that is barely a dent when you consider the massive size of the US market. Now, at the same time, unemployment rate, it rose from 4.2% to 4.3%. But I think the bigger story here is the revisions. June and July numbers were revised down by a combined 21,000 jobs. So in June, the updated numbers show something that is very rare. The US actually lost 13,000 jobs that month. When you put this all together, the first 8 months of 2025 have seen the US add about 598,000 jobs. Now you compare that to the 1.1 million jobs that were added during the same period in 2024, or the 1.8 million that were added in 2023. If we ignore the pandemic year of 2020, this is now the weakest job growth since 2009. And remember back then, the US was still digging out of the great financial recession. So I want to look at the full North American picture here. Both Canada and the US clearly are showing signs of a cooling labor market. Canada's unemployment rate climbing faster. The US is seeing a slower, but still a concerning deceleration in job creation. When you look at it on the surface, the US unemployment rate of 4.3%, that does look way better than Canada's 7.1. But when we look at the trajectory here, that matters. Both countries are trending in the wrong direction. And in both cases, these reports caught the economists off guard. Remember here that the forecast expected modest job gains, not losses in Canada, or what turned out to be near stagnation in the US. So we see weak job reports in both Canada and the US, and when the labor market softens, investors often naturally start searching for stability and reliable income. And that is why I do want to take a moment and thank Harvest ETFs for supporting this video. And I want to highlight their brand new Harvest Canadian High Income Shares ETF. The ticker is HHIC. And this fund holds many of Canada's dominant companies: banks, telecoms, energy producers, tech, and mining, all businesses with strong cash flows and long histories of paying dividends. Now, by combining these companies with Harvest's active covered call strategy and some modest leverage, HHIC is designed to deliver high monthly cash flow along with long-term growth potential. So if you're looking for income and stability that's built on Canada's best companies, take a closer look at HHIC. You can learn more at harvestetfs.com, and I will leave a link in the description of this video. Okay, so let me tell you why I say this is also important. That is that these job reports weigh heavily on the central bank decisions. In Canada, when the weak jobs numbers came out last week, it immediately pushed the financial markets to raise the odds of a Bank of Canada rate cut at its next meeting on September 17th. As of today, that stands around 90%. Now, some economists, they are saying that a quarter point cut is almost certain, with the possibility of another before the year's end. But here's a very interesting twist on this. Inflation data drops literally one day before that meeting. We have inflation out on the 16th. The rate decision is on the 17th. So what if inflation stays sticky? Or heaven forbid, what if it goes up? Is it going to be possible that we will see the Bank of Canada hesitate here? Remember, the odds today are of a cut of 90%. Now in the US, the Federal Reserve, well, same dilemma there. We see job growth slowing, unemployment itching up, and the markets are widely anticipating a rate cut later this month. According to the Fed Watch tool, there's an 88.4% chance of a 25 basis point cut, 11.6% chance of a 50 basis point cut when they next announce. But inflation is still running hotter than what the Fed would like. July's report came in at 2.7%. That is higher than what the Fed wants. More importantly here, the core inflation rate was at 3.1% and going up. Now this Thursday, in just a few days, they will report for August, and that will definitely be interesting. Now, if the Fed does cut next week, that would give the job market some breathing room, no doubt. But of course, that would come at the risk of reigniting some pressures on the price. So on both sides of the border, central banks are stuck at this same balancing act. Do you support growth without letting inflation flare back up? How do you manage that? Now, I do want to talk a little bit about the political backdrop here, because it's impossible to separate these numbers from what's going on both here in Ottawa and in Washington. Here in Canada, the trade tensions with the US, they've been weighing on exporters for years now. This is nothing new what we're going through now, although the new tariffs have sort of complicated that issue or brought it to the front. But when we look, even with the Canada-US-Mexico trade agreement in place, specific tariffs on steel, aluminum, autos, they are still creating headwinds for the Canadian economy. You think about it, these sectors, they employ thousands of workers. They're directly tied to the global demand. So that means that job losses here ripple down through our economy. In the US, politics, of course, as always, seem to be front and center. And we've got President Trump boasting about what he calls the Trump effect on the economy. But let's look at the data here. It tells a different story. As we have seen, job growth has slowed to a 16-year low. The firing of the head of the Bureau of Labor Statistics, Trump did that last month. You probably heard about that. That didn't change the outcome this time around. So Canada's job losses are troubling. In the US, the slowdown is raising bigger questions about whether the president's economic agenda is even working at all. So where do we stand? Well, both economies are clearly cooling, but in slightly different ways. In Canada, we see outright job losses. The US is still adding jobs, but at a very slow pace. I would say probably an anemic pace right now. Yes, in Canada, wages are rising, but in the US, we see the wage growth hasn't been as strong, and not strong enough, at least, to offset inflation. So for those policymakers, this is a very, very thin tightrope. I would say too many rate cuts that could bring inflation back, but staying on hold for too long, that could risk pushing the job market into deeper trouble. Now, for the workers here, it raises the question, if both economies are slowing at the same time, think about it for a moment. What does that mean for people out there right now who are looking for jobs? So I'm going to look ahead now, next few months, and suffice to say, this is going to be a critical time period. In Canada, I referenced it, that September the 16th inflation report that could make or break a case for rate cuts. If inflation comes in tame, the Bank of Canada, I think, will feel comfortable cutting rates the next day. But what if that report comes in hot? Then I would say that all bets are off there. In the US, the Fed, they'll be watching not just inflation, but also they have to watch now whether job growth rebounds in the fall or whether it continues sliding. If the economy closes out the year with fewer than 1 million jobs, that is less than half the pace of the last 2 years, remember, then that would raise recession concerns heading into 2026. The broader takeaway, both Canada and the US here are facing the weakest labor markets that they have in years, and central banks are under pressure to act. So that is the full picture. Canada losing tens of thousands of jobs, the US barely adding any, both economies flashing warning signs. Question for you, do you think that the central banks should cut rates aggressively to protect those jobs, or hold firm to keep inflation under control? Let me know what your thoughts are in the comment. And if you found this video helpful, consider subscribing or sharing the video. As always, I say thank you for watching, and we'll see you next time.